Okay, happy Valentine's Day, you lovebirds. We are here this week to talk about love and taxes because they go hand in hand. So, before I proceed with this week's tax tips, I'm curious, what is your favorite love song of all time? I'm gonna give you mine, okay? I'm not sure if you could play it on YouTube because I don't want to get a copyright strike, but my favorite love song right now that I'm listening to is Two Dozen Roses by Shenandoah. I'm gonna put it in the screen right here. Go and listen to it, especially if you are a big country fan. Listen to the song, tell me what you think. But you drop down in the comments below what is your favorite love song or Valentine's song or maybe making song of all time. Okay? Put in the comments. I'm curious to hear from you guys. Alright, let's get to the tax tips of this week. Okay? Love and taxes. We get clients all the time who have found that special somebody. They got married and then they come to us and they ask, should we file married filing joint or married filing separate? Before we get to that question, let me give you a pop quiz, okay? If Johnny and Suzanne meet on January, okay, they start dating in January, but they don't get married until December 1st of the current year, are they considered married for the whole year? Yes or no? I'll give you 3 seconds. Three, two, one. If you answered yes, you are correct because the IRS says that even if you were married on the last day of the year, you are still considered married for the whole year. Okay? So going back to our question, is it better to get to file married filing joint or married filing separately? Okay? And I will tell you like this. There's pros and cons to both sides, just like everything else in life. But I will say that there's more pros to filing married filing joint. In fact, I will say as much as there's only a few circumstances where it makes more sense to file married filing separately. Okay, so we're gonna go over all that today, but let's start from the very beginning. Okay, why is it more advantageous to file married filing jointly? So number one, you have a wider income range for a lower tax bracket. What do I mean by this? Okay, my team is going to put a picture right here that's going to illustrate what I mean by this. Okay, so I'm gonna pull this thing up right now. So, for example, okay, if you are filing married filing separately and you make anywhere between $48,476 to $103,350, you are already at the 22% tax bracket. Versus if you are filing married filing joint and you make anywhere between $96,951 to $206,700, you are at still at 22% tax bracket. Why did that matter? Let's give you an illustration, okay? So let's say you have a couple, right? And let's say the husband makes 150,000 and then the wife makes $50,000. Well, if they filed married filing separate, okay, the husband would already be taxed at 24%, okay? Versus if they filed married filing joint. Since the husband makes 150 and then the wife makes 50, they are still under $206,000, which would give them a tax bracket of 22%. But in my example, if they filed married filing separate, since the husband makes more than $103,350, $103,350, he would already be taxed at 24%. Okay. Also, you get more of a standard deduction. So, married filing joint for 2025, you get $31,500. For married filing separate, you only get $15,750 per spouse. And that's not the only thing that you need to be worried about. If you file married filing separate and one spouse decides to itemize their deductions, that means that both spouses need to itemize their deductions. So, what does that mean in reality? Imagine if, let's say, one spouse has more than $15,750 of itemized deduction, so that's great. He can itemize that. But what if the other spouse doesn't have any itemized deductions? Therefore, they would not be able to have any deductions because they would not be entitled to the standard deductions, and also they don't have any itemized deductions to deduct. So that can be a big potential tax liability for the spouse who doesn't have any itemized deductions or standard deductions. Okay, so that's something to be very mindful of when they're filing, maybe filing separate. Okay, next thing is retirement accounts. If you file married filing joint, you can contribute more to your retirement accounts, which can lower your taxable income. Okay, so let's take something practical that most people are familiar with, which is the solo 401k. Okay, so when you contribute to a solo 401k, you can defer that income, which lowers your taxable income. Okay, which will lower your taxes overall. So if you are married filing separately, then you can only contribute the contribution limit, which is $73,500. Okay, but if you are married filing joint, and both spouses work at the business, and both spouses get paid a compensation at the business, then each spouse can contribute $73,500 to their solo 401k, which will maximize the reduction in their taxable income. All right. Okay. Another thing that's a big advantage of filing joint is the real estate professional status. So normally there's a lot of challenges for people who work W-2 jobs who want to qualify as a real estate professional. Okay. So remember, there's a couple of things at play here. Number one is normally if you make over $150,000, you normally cannot offset your active income with your passive losses, right? So what does this mean? So this means that you cannot offset your W-2 income with your losses from your rental, which will result in higher taxable income, okay? Not unless you can qualify as a real estate professional, all right? So when you qualify as a real estate professional, you need to have 750 hours of real estate activities. 51% of your time needs to be dedicated to real estate. So that's where most people fail when they have a W-2 job, right? Because if you have a full-time job as a doctor or a lawyer or a personal trainer, how can you prove that you spent 51% of your time on real estate when you have a full-time job, right? And also, you need to have 500 hours of material participation on your own properties. Okay, so normally most single professionals fail at the real estate professional status, and then their passive losses are just suspended, right? But if you get married, if one of the spouses qualifies for the real estate professional status, what will happen is that both spouses qualify for the real estate professional status. Meaning that if, let's say, Bobby, full-time W-2 earner, high-income earner, he is a dentist, and then his wife, oh, Peggy Sue, she's a stay-at-home wife, okay? And then Bobby makes all the money. So what they could do is they could buy a rental property, okay? Qualify Peggy Sue as a real estate professional, and then they could offset their passive losses from their rental property to decrease Bobby's active income. So let's say a rental property after bonus depreciation, cost segregation, all the operating expenses, it has a $200,000 passive loss. And let's say Bobby makes $300,000. $300,000 offset by the $200,000 of passive losses. That's only $100,000. So you're able to bring down your taxable income significantly. Okay, you can also do something similar for short-term rentals. When it comes to short-term rentals, the requirements are even lower. You only need to hit 100 hours. And if one of the spouses or both of the spouses combined hit that 100 hours, and you can use the losses from the short-term rental to offset the active income of the high-income W-2 earner. All right. So there's only a couple of things that it makes more sense to file married filing separate. Number one is if your spouse is doing something super shady on the taxes and you don't want to get tied up to that, then yeah, it makes sense to file married filing separate. Or if your wife or your husband has a lot of business losses and you don't want those losses for some reason, whether it's you're trying to qualify for a loan pretty soon, right? So you don't want those losses. So that might be a reason why you would file married filing separate. But other than those, I really cannot think of any other reason why you would file married filing separate. Okay. All right. Let's talk more about how life happens. Okay. So you meet a girl at the bar or at the local honky tonk. Okay. You meet a nice blonde or a nice brunette at the bar. Okay. You guys get married. You guys use the real estate professional tax status for tax purposes, or the short-term rental loophole with the cost segregation and bonus depreciation to really save a lot of money in taxes, and now you have a lot of money saved up, so you use that money to go and buy more properties, and now you have more passive income. So what do you do with all that money? You go to the stork, right? You go to the stork and you ask the stork to bring you a baby, right? Because that is how babies are raised. They come from storks. That's what my mom told me, that babies come from storks. So this is very important. Once the stork brings the baby, there's a couple of things I want you to be mindful of, okay? So there is something in the One Big Beautiful Bill Act that passed on July 4, 2025 that talks about the Trump account. What is the Trump account? The Trump account is if a baby is born from a stork between 2025 and 2028, the U.S. government, as long as they are a U.S. citizen, will give them $100,000, okay? And that money goes into a account. That money is invested in the market. You cannot touch that money until the kid turns 18 years old. And during that time, the growth of that money, which means interest, is not taxed. Okay? And also, once the kid turns 18, then you can consider converting it into a traditional IRA or a Roth IRA, or you could also have different options as well, whether it's paying for education or a business, things like that. But we're going to be talking about those Trump accounts and what are qualified withdrawals in our next week's episode. Okay, so stay tuned for that. So remember, if you have any questions, if you want to become a client with our firm, please schedule a call by hitting the link below. And don't worry, your accountant handles that.